Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. This stock analysis video will be about the company Alphabet. However, Alphabet's best known subsidiary company is Google. Google was founded in September 1998 by Larry Page and Sergey Brin at Stanford University while they were PhD students. Google is best known for its search engine, Google.com. Some of their notable products and services include Google Search, Google Drive, and Google AdSense. Alphabet has also gotten into the research and development of new technologies in recent years. Alphabet separates their company into two main segments: Google Advertising and Google Other Revenues. In 2019, the company's largest segment was their advertising segment, which generated them $171 billion in revenue. Google's Other Revenue segment has been growing quickly, responsible for 15% of the company's revenue in 2018 compared to 2015 when it was just 10% of the company's revenue. Alphabet is currently the fourth largest company in America and currently has a market cap of $879 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Alphabet earned $20.57 per share. In 2015, this value jumped up 11% as they earned $22.84 per share. In 2016, Alphabet earned $27.85 per share, a 21.9% increase from the previous year. In 2017, Alphabet earned $18 per share. This was a 35.4% decrease from the previous year. In 2018, Alphabet earned $43.70 per share. This was a massive jump of 142.8% from the previous year. And in 2019, Alphabet earned $49.16 per share, which was a 12.5% increase from the previous year. This data indicates that Alphabet has grown on average 19% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price to earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of April 26th of 2020, Google was trading at $1,279.31 per share. This represents a trailing 12-month price-to-earnings ratio of 26.02. This PE ratio is higher than the trailing 12-month PE ratio of the Standard & Poor's 500, which at the time of this recording was 20.3. This falls in line with the PE ratios of some of the other large technology companies in America, with the exception of Amazon, whose PE ratio is pretty close to 100. In this next slide, I will be talking about the company's price to earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of April 26th of 2020, Alphabet was trading at $1,279.31 per share. This represents a trailing 12-month price-to-earnings growth ratio of 1.58. This indicates that Alphabet may be overvalued if you use this metric solely to evaluate Alphabet. However, I caution investors against using this metric solely to evaluate a company like Alphabet, who has just had a high amount of growth over the past few years, as it may give an inaccurate representation of the stock's true worth. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects, as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. Alphabet currently does not pay a dividend, as they choose to reinvest the money that they earn into growing their company. Alphabet is investing in a lot of new products and services. They've invested in things like productivity software, such as their Google Drive software, to things like driverless cars. Google could offer a dividend in future years if their growth starts to slow. However, I predict that as they continue to diversify their business and invest in all these new technologies, they will probably continue to keep reinvesting in those technologies and not pay a dividend. In this next slide, we will be going over the company's price-to-book ratio as well as its debt-to-equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt to equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt to equity ratio is not necessarily a bad thing. As of December of 2019, Alphabet had a book value per share of $292.65. This represents a price to book ratio of 4.37. As of the beginning of the year in 2020, Alphabet had a debt to equity ratio of 0.07. This is a very low debt to equity ratio, and it indicates that Google is not borrowing a lot of money in order to run their business. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Alphabet stock on April 1st of 2017 and held it for 3 years, you would have seen an average annual return of 10%. If you had bought Alphabet stock on April 1st of 2015 and held it for 5 years, you would have seen an average annual return of 17%. And if you had bought Alphabet stock on April 1st of 2010, held it for 10 years, you would have seen an average annual return of 15%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Alphabet a grade of A-. I really think that Alphabet can continue to sustain their earnings from advertising in the near future, and that makes up a large portion of their revenue. They own both Google AdSense as well as YouTube, so they pretty much dominate the online advertising space. I also really like that they have such a low debt-to-equity ratio, as that indicates the company could probably weather an economic downturn pretty well. As a growth investment, I gave Alphabet a grade of A. Alphabet is probably known as one of the most innovative companies in the world. They have some really cool research projects, and I'm really excited to see what they come out with in the near future. Alphabet has one of the largest research and development budgets in the world out of any company, and they use very little debt to fund that research. As an overall investment, I gave Alphabet a grade of A. I really like that they have a rock-solid advertising segment of their business and that they take some of that money and reinvest it into new technologies. I think this makes Alphabet a fantastic company to own. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching and take care.